I want you to picture a restaurant. Same building, same kitchen, same chef. But depending on which door you walk through, you get a completely different meal. Different quality, different price, different waiter, different level of respect. And nobody tells you there are 3 different doors. That restaurant, it's your bank. And today, I'm going to walk you through all 3 doors. I'm going to show you the waiting room most people sit in, the private lounge most people don't know exists, and the secret floor above that, where the rules that apply to everyone else simply don't apply anymore. Because here's what I've come to understand after studying how financial institutions actually operate at every wealth level. The bank you think you have, and the bank that wealthy clients actually have, share a logo. That's about it. Let's talk about that. To make this concrete, I want to introduce you to 3 people. They're fictional, but built from real patterns. Nadia is 29 years old. She works as a pharmacy technician making around $38,000 a year. She has a checking account, a debit card, and a savings account with about $400 in it. She's not irresponsible. She's just navigating a financial system that wasn't built with her in mind. Marcus is 41. He works in management. He earns around $95,000, has a 401k, a modest investment brokerage account, and keeps about $80,000 spread across his bank accounts. He's the person most financial advice targets, the responsible middle class. Raymond is 61. He's a retired entrepreneur who built and sold a regional manufacturing company. His liquid investable assets are around $4.5 million. He has the same bank logo on his card as Nadia does. That's the setup. Same bank, same brand, same branch address on the website. Now let me show you how 3 completely different banks operate inside that one building. Let's start with something that happens to almost everyone at some point. A financial hiccup. A charge comes through at the wrong time. A payment clears before a deposit does. A fee you didn't see coming hits your account. What happens next depends entirely on who you are. Nadia's car insurance auto-pays on the 14th. Her paycheck doesn't hit until the 15th. A $180 payment processes when she has $142 in her account. The bank covers it, technically, and then charges her $34 for the privilege of having her account go negative by $38. She gets no call, no text warning, no grace period offered. The system processes the fee automatically, and by the time she checks her balance on her lunch break, she's already down $34 she didn't plan to lose. When she calls to ask about it, the wait time is 28 minutes. When she finally reaches someone, she's told the fee was applied per account terms. She asks if it can be waived. The agent puts her on hold. Comes back, says this one time, just this once, they can credit it. But one more time, and it sticks. She thanks them like they did her a favor. They kind of did, by the system's own design. Marcus has the same thing happen. A charge cleared before his transfer moved. His account dips briefly below 0. He gets a push notification within minutes. The app offers him the option to move money from savings with one tap. He does. The overdraft fee is assessed, $34, but the next time he's in the branch, his relationship manager mentions it was credited back automatically because of his account history. He didn't ask, it just happened. Raymond's account is attached to a personal line of credit with a negotiated rate. If his balance ever approaches 0, which it essentially never does, funds are automatically drawn from that line to cover it. His private banker has his cell number. If something unusual ever flagged on Raymond's account, the banker would call him directly before any automated system even had a chance to act. I want you to really sit with that. Not 3 different policies. One policy, applied with 3 completely different levels of discretion. That's not an accident. That is design. The customers least positioned to absorb the fee are the ones paying it most often. This is the first way the system compounds advantage at the top and compounds cost at the bottom. Now let's talk about the physical experience of banking. Because I think when people imagine a bank, they think of one thing: a lobby, a teller line, a wait. That's accurate for most people. But it's not the only version of a bank that exists. Nadia walks into the branch to deposit a check she can't mobile deposit because it's from a small business and the image didn't scan right. She takes a number. She waits. Around her, there are plastic chairs, a water cooler, a TV mounted in the corner playing news on mute. She waits about 20 minutes before her number is called. The teller is friendly. The transaction takes maybe 90 seconds. And that's it. No one follows up. No one offers advice. No one notices that she's been a customer for 6 years. Marcus comes in less often, maybe once a quarter. When he does, the wait is shorter, partly because he comes during off-peak hours, partly because he has a premium checking account that lets him use a shorter queue. A personal banker has reached out to him twice this year by email, offering to schedule an account review, suggesting a new CD rate. He's recognized. Slightly, in the way a regular at a chain restaurant is recognized, with familiarity but no particular care. Raymond doesn't use the lobby. He hasn't in years. His bank branch has a private entrance on the side. When he comes in, which is also rare, because most of his banking happens through one phone call or one email, he's met at the door by his dedicated private banker. There's a room. An actual room, with good furniture, real coffee, and no background noise. The meeting isn't about a transaction. It's a conversation about his portfolio strategy, an estate update his attorney sent over, and a conversation about a charitable giving vehicle his daughter is exploring. The actual transaction, a wire transfer, gets processed by someone else in the background while Raymond talks about his family. Same building. 3 completely different definitions of what it means to be a customer. Here's the word that explains the entire difference: relationship. Nadia is an account number. Marcus is a customer. Raymond is a relationship. And the word relationship in banking is not about warmth. It's about revenue. Raymond generates significant revenue for this institution. His deposits fund their lending. His investment assets generate advisory fees. His trust structures generate legal and administrative fees for years, sometimes decades. The service isn't charity, it's raw. And understanding that completely changes how you think about what you're owed and what you have to do to claim it. Now we get to the part that I think is the most important and the most infuriating once you see it clearly. The price of money. Because borrowing money isn't a fixed thing. The rate you pay, the interest, is not a number written in stone. It's a negotiation. And the terms of that negotiation depend almost entirely on how much you already have. Let me walk you through all 3. Nadia needs $3,000. Her furnace broke during winter. She doesn't have the cash. She goes to the bank and applies for a personal loan. She's denied. Her credit score is 611. Not catastrophic, but not strong. Her income-to-debt ratio, with student loans, puts her above the bank's preferred threshold. She's offered a secured credit card instead. She deposits $500 of her own money. The bank holds that money as collateral and gives her a $500 credit line at 26.99% APR. Let that land for a moment. She deposited her money so the bank could loan her own money back to her at 27% interest. Marcus needs $25,000 for a home addition. He applies online. By Tuesday, he has a pre-approval. His rate, 7.4%. The process was smooth. The funds arrived in days, and the monthly payment fits comfortably into his budget. This is how most people think lending works, and for Marcus, it does. Raymond needs $1.8 million to bridge a commercial real estate deal while he waits for another asset to sell. He doesn't fill out an application. His private banker calls him. They have a conversation. The banker comes back with terms, not published terms, negotiated terms. The rate offered to Raymond for $1.8 million is lower than the rate Marcus was offered for $25,000. Nadia, $500 at 26.99%, borrowing her own money back. Marcus, $25,000 at 7.4%, standard approval, standard terms. Raymond, 1.8 M at 4.3%, negotiated, unpublished, relationship-based. I want to be precise about something here. The bank is not doing this out of generosity. They're pricing risk. Raymond is statistically less likely to default. He has assets, income history, and collateral many times over what he's borrowing. From a pure risk standpoint, lending to Raymond is safer than lending to Nadia. But here's the systemic consequence. The person with the least financial cushion pays the most for money. The person with the most pays the least. Every dollar of interest Nadia pays at 27% is a dollar she can't save, can't invest, can't use to build toward a Marcus or Raymond tier. The cost of being poor is not just the absence of money. It's the active, continuous drain of money through 100 small expenses that simply don't exist at higher wealth levels. This is how the gap widens, not through a single dramatic event, but through thousands of tiny structural transfers, year after year, invisible, unless you know where to look. Here's a dynamic that nobody talks about: the information asymmetry between you and your bank. Your bank knows a staggering amount about you. Transaction by transaction, it builds a profile: where you shop, how often you're near zero, whether you pay bills on time or scrape through at the last minute, how your income has moved over the years. For Nadia, that profile is processed entirely by software. No human has ever reviewed her account. She is a set of numbers in a risk model. The bank's interest in her is limited to, is she profitable to hold, or is she a liability? That analysis, by the way, happens automatically and continuously. And the results affect what products she's offered, what fees she's charged, and what marketing she receives, without her ever knowing. For Marcus, a human occasionally looks at his profile, usually when he triggers a review by applying for something or reaching an account milestone. He exists in the middle zone, worth keeping, not worth pursuing. For Raymond, a real human being, his private banker thinks about him regularly, reviews his portfolio, anticipates his needs, knows what he cares about and what he doesn't, and brings him opportunities before he has to ask. Meanwhile, what do they each know about the bank? Nadia knows her balance, her fee schedule buried in fine print she never read, and the number on the back of her card that puts her in a 30-minute queue. Marcus knows a bit more. He's gotten occasional calls. He knows there's a premium checking tier. He has a vague sense that wealthier customers probably get better rates. Raymond knows exactly how the bank makes money from him. He knows what he's worth to them. He uses that knowledge as leverage, and his banker knows he knows. That's not a coincidence. Knowing your value to an institution is itself a form of power. And it's a power most people are never handed. Let's talk about something most people will do at least once in their lives: buying a home. Because the mortgage is one of the clearest examples of how the system prices you based on who you are, not just what you're buying. Nadia is buying her first home, $210,000. She's doing everything right, she's been saving, she found a realistic price point for her income. Her down payment is 5%. Because it's under 20%, she's required to carry private mortgage insurance, an extra monthly cost she pays, which protects the bank, not her, in case she defaults. Her mortgage rate, based on her credit profile, 8.1%. Over 30 years, on a roughly $200,000 loan, she'll pay approximately $332,000 in interest alone. She's paying the bank over $1.50 for every dollar she borrowed. And the me adds a layer of cost on top of that for years until she hits 20% equity. Marcus is buying at $450,000. 20% down means nope me. His credit profile is clean. His rate, 6.5%. On a $360,000 loan over 30 years, he pays approximately $459,000 in interest. Higher total because the loan is larger. But per dollar borrowed, he pays less than Nadia does. Raymond is buying a $3.8 million property. Cash for part of it, jumbo mortgage for the rest. His bank's wealth lending division handles jumbo loans differently from the standard mortgage desk. The rate isn't posted. After negotiation, 4.7% on a $2.5 million mortgage. He pays approximately $2.3 million in interest over 30 years. Large number, but per dollar borrowed, Raymond pays about 92 cents in interest for every dollar borrowed. Nadia pays $1.66 per dollar borrowed. The bank is not being irrational. It's pricing risk. Raymond has more collateral, more income stability, more assets to fall back on. From a pure actuarial standpoint, he's less likely to default. But the consequence, unintentional or not, is that the path out of the bottom is made steeper by the cost of being at the bottom, and the people already at the top get the cheapest runway to build even more. Understanding this doesn't make you bitter. It makes you strategic. And I want to talk about strategy in a moment. Everything I've shown you so far might feel heavy, and that's because it should. The system is real, and the disparities are real. But here's what I want to leave you with, because this isn't a video about helplessness. This is a video about seeing clearly, so you can act clearly. The tier system in banking is not a cage, it's a ladder. And while it's harder to climb from the bottom than from the middle, it is climbable. I've seen it happen, and the mechanics are more specific than most people think. Here's what actually moves you up. Step 1. Stop being unpredictable. Banks price unpredictability. Overdrafts, missed payments, volatile balances, these are all signals that say high risk. Even if your income is modest, stabilizing your account behavior changes how you're scored. Set up a minimum balance alert. Build even a thin buffer, $200, $500. Make your account history boring. Boring is good. Step 2. Understand the product thresholds at your bank. Every major bank has tiers, often called something like standard, preferred, platinum, private. Each tier has a deposit minimum. When you cross that threshold, your fee structure changes. The service level changes. Start asking, what's the next tier above where I am? And what does it take to get there? Step 3. Negotiate like you know your value. Because you do. Most people never ask their bank for anything. They accept whatever they're offered. That's a mistake. If you've been a customer for more than 2 years, you have standing to ask for things. A fee waiver, a better rate on a savings product, an introduction to a loan officer rather than an online application. The worst they can say is no. And you'd be surprised how often the answer isn't no. Step 4. When you're in the Marcus tier, start thinking like Raymond. Marcus's biggest risk isn't that he's not wealthy enough. It's that he doesn't know how wealthy he's becoming. At $80,000 to $250,000 in assets, you start to have real leverage with your institution. Request a relationship review. Ask what private banking looks like at your bank and what the threshold is. Get on the radar of someone with authority. Step 5. Diversify before you need to. The most powerful thing Raymond has isn't his money. It's his options. He can walk to a competitor at any moment, and they will compete for his business. Multiple institutions knowing your name is not disloyalty, it's leverage. So let me bring it home. One bank. 3 completely different experiences. Nadia is being processed by a system that profits from her unpredictability and charges her for it. Marcus is being served adequately, transactionally, and doesn't yet realize he has the leverage to ask for more. Raymond is being pursued, anticipated, competed for. And he knows it. The question isn't which one of them is smart or hardworking. All three of them might be. The question is which tier of the system you're currently in, and whether you're doing anything intentional to move up. Here's your homework. This week, call your bank. Not to complain. Just to ask one question. What's the next tier above my current account, and what do I need to do to qualify? That conversation alone tells you something important. If they can answer it, great, you have a target. If they can't or won't, that also tells you something about whether this institution is worth your long-term loyalty. You are not obligated to stay in the waiting room. If this video opened your eyes to something you hadn't seen before, share it with someone who needs to see it. And drop in the comments, which tier are you in right now, and what's your next move? I'll see you in the next one.